Would you like to make your audits more efficient? I thought so. I'm going to tell you how in this video about relevant assertions. I have reviewed literally thousands of audit files through the years, and many times when I look at certain work papers, I'm asking myself, why is this in here? And boy, they really wasted a lot of time doing this because it's unnecessary. So one of the questions I get when I work with other CPA firms is, how can I reduce the amount of time I've got in the audit? If you understand relevant assertions, you can reduce some of the procedures you may have been doing in the past. I think most auditors, including myself, we do the same as last year sometimes, do we not? What we call Sally. We'd like to get rid of Sally and only perform the procedures that are needed. So here we are in chapter 14, relevant assertions, and notice it's not called irrelevant assertions. We want to know what is relevant, what we have to do. And if we use the assertions in the right manner, then we'll be able to focus on what is relevant. Anytime you look at a set of financial statements, those statements should be speaking certain things to you and to any other user of the financials. Such as when a financial statement has a cash balance of $605,432, the business asserts that the cash exists. So when you look at the line that says cash and it has a balance there, the business is asserting that the cash exists. Otherwise, it wouldn't be there. So existence is quite often a relevant assertion for cash. I would say it's always a relevant assertion. Another example here is the allowance for uncollectibles. When you see that in the financial statement, on the balance sheet, or in a disclosure, the entity is asserting that that amount is properly valued. So now we have the valuation assertion coming into play. Another example is in payable. So when you see accounts payable on the balance sheet, the business is asserting that that balance is complete. Another assertion, completeness. And they're really saying to you and I on the balance sheet that all of the invoices that should have been accrued at the end of a period are included. So in these examples, we see three relevant assertions: existence, valuation, and completeness. In this slide, we see the assertions or the potential assertions that are in play for any entity that you audit. And they are existence or occurrence, completeness, accuracy, valuation, and allocation, rights and obligations, presentation, disclosure, and understandability, and cutoff. Now, one observation I want to make about assertions is when you look at existence, that is quite often in play for assets. Now think about it. If a business would like to look healthier than it really is, what would they do in relation to assets? That's right, they would overstate the assets to make the business look better. So the directional risk for existence is that the assets would be overstated. So quite often, existence is a relevant assertion for assets. Now, conversely and logically, completeness would be a relevant assertion in relation to liabilities. Again, if the business desires to make itself look better than it really is in relation to liabilities, what would they do? Yes, they'd understate the liabilities. So the directional risk for liabilities is that they would be understated. If management's trying to play with the numbers and make the company look better than it is, then they're going to understate the liability. So completeness is quite often a relevant assertion for liabilities. So for assets, existence usually is in play. For liabilities, completeness is usually in play. Usually in relation to receivables and cash, cutoff would be a relevant assertion. You want to make sure you've discontinued recognizing revenue at the end of the period, so you want to cut off the receivables at the right time. Also, in regard to bank reconciliations and cash, you want to make sure that those outstanding items on the bank reconciliation are appropriately included or excluded, that you've got proper cutoff on bank reconciliations. The third bullet there, you see allocation. You want to make sure that, for instance, depreciation is allocated appropriately over periods. We talked about valuation in relation to the allowance for uncollectibles. I think for accuracy, again, with the third bullet, that can come into play really for just about any account balance or transaction cycle. Rights and obligations, if there's some question as to whether or not the entity would own an asset or whether or not they would owe under an obligation, then this one can come into play. On presentation, disclosure, and understandability, that fifth bullet comes into play usually in regard to disclosures for understandability, and then presentation in terms of how things get classified on the balance sheet, income statement, and cash flow statement. So those are just some general ideas about assertions and how they might come into play for your entities. Which of these assertions are relevant, which are irrelevant, and those that are irrelevant we can pretty much ignore. Those that are relevant, we're going to perform some audit procedures to make sure that everything is okay. So what is a relevant assertion? Well, it's an assertion where there's a risk of material misstatement that is reasonably possible. Now, that term reasonably possible, you may be wondering, what does that mean? If you look in the literature, it means more than remote. If there's a more than remote chance that you're going to have a risk of material misstatement, the assertion is relevant. So you're really looking at two things here. You're looking at magnitude, how much could the misstatement be, and is it material or potentially material, and then likelihood, is it reasonably possible? Both of these need to be in play for an assertion to be relevant. Now, as you determine the relevant assertions, you're trying to determine where you should focus your energies. It's not like you and I have an unlimited budget to perform an audit. We don't have thousands of hours to do an audit. We might have 200 or 300 hours. And so in that audit budget time, we want to focus on the areas that are relevant. And that's why this is so important as you plan your audit engagements. So not every assertion is relevant. Sometimes I look at audit files and it's as though the auditor thinks every assertion is relevant. They are not. quite often for an account balance or transaction cycle or disclosure, there will be 2 or 3 assertions that are relevant. So sometimes assertions are not relevant. In the slide, I say the valuation assertion is not relevant for cash. Well, why is that? Well, because usually when you're auditing, say, a U.S. company, or if you're say, in Europe and you've got euros that you're dealing with, there's usually only one currency that you're dealing with. So you don't have a foreign currency issue, and therefore valuation is irrelevant. You don't really need to do anything in regard to that assertion for cash. Recently, the AICPA has found that auditors quite often assess risk for several assertions at the account balance level, and we shouldn't do that. So in this example, you see cash and then you see several assertions, and then the auditor is assessing inherent risk and control risk and the risk of material misstatement for all of those assertions. Well, all of those assertions are not going to have the same risk profile, so it's inappropriate to do several assertions at one time or in the aggregate. We should be assessing risk at the individual relevant assertion level. On this slide, you'll see a typical risk assessment for accounts payable. You'll see the assertions here: existence, occurrence, completeness, and cutoff for accounts payable. And then you're seeing inherent risk, control risk, and the risk of material misstatement stated separately for each individual relevant assertion. Now notice I don't have every single potential assertion over on the left. I only have the relevant assertions. We had said earlier for liabilities that the completeness assertion, that's this one, is usually in play for liabilities. So I've got that down as a relevant assertion. I've got cutoff as a relevant assertion because we want to make sure we have the right invoices in that accounts payable accrual at year end. And then I've got occurrence also as a relevant assertion. Now, why would occurrence be a relevant assertion? Well, you think about expenses or revenues. If they don't occur, they don't exist. So usually occurrence is a relevant assertion for revenues or expenses. So in this example, I have 3 relevant assertions for accounts payable and expenses, and those are occurrence for the expense, and then completeness and cutoff for the accounts payable balance. And you can see the risk of material misstatement. For occurrence, I'm saying it's moderate. And for completeness, I'm saying it's high because of that directional risk that it might be understated. And then for cutoff, I'm saying it's moderate. And then you see the linkage out to the right. So here's my risk. I've done my risk assessment by assertion. And then here's my response or my linkage out to the right. Now, in the response column, if you do it this way, if you document your assessment in this manner, I wouldn't list every single audit procedure that I'm going to do out here on the right. I would just link out to the key audit procedures that you're going to perform in response to this risk of material misstatement. For example, for occurrence, I'm doing substantive analytics and I'm comparing expenses in this year to budget and prior years. On my high completeness assertion, I'm performing a search for unrecorded liabilities to make sure that everything that should be in payables is included. And then on my moderate cutoff assertion, I'm doing substantive analytics comparing payables this year with payables in the prior years. Now, before I close, I want to go back to one slide in particular that we've looked at in this video. And this slide tells us that the relevant assertions are those where there's a risk of material misstatement that is reasonably possible. So when you consider all of the different assertions that can come into play for an account balance, such as cash, or payables, or receivables, or revenues, for example, think about, is there a risk of material misstatement? In other words, could there be a misstatement that is greater than materiality? And then ask yourself, is it reasonably possible that a material misstatement could occur for that particular assertion? If the answer is yes, then it's in play and we would need to assess that assertion. If the answer is no, then it's irrelevant, and I'm not going to document an irrelevant assertion because there's really nothing to do. There's no risk of material misstatement, at least in our judgment. I emphasize again that these are judgments. I find that auditors often almost freeze when it comes to these kind of decisions, and I just want to encourage you, loosen up some and make your best judgment and move forward, and you'll be fine. In today's video, we've looked at relevant assertions, and we see that by understanding what those are, that it gives us direction in regard to what we need to do. And also, importantly, what we don't need to do. So we look at the potential assertions for each account balance, each transaction cycle, each disclosure, and then we determine which are relevant because there's a risk of material misstatement that is reasonably possible. And then based on those assertions, we're going to look at inherent risk and control risk and the risk of material misstatement. In next week's video, we're going to take a look at inherent risk, and we'll take a pretty deep dive on that area because I find that people get very confused about inherent risk. So until we meet again, take care and God bless. Bye now.